the economy was in recession. I mean, it was obvious that stuff was bad. Things are supposed to be good now, according to the government, according to the Fed. Everything is great. So if consumers are this pessimistic now, what are they going to be like during the recession, the next recession? I think gold and silver are going to break from this correction, and they're going to be headed higher into the end of the year. That'd be my guess.
The Federal Reserve knows that the next recession is not going to be a recession. It's going to be a depression. So that's the reason why the Fed is panicking already, and why no one's going to preemptively hike interest rates a lot or really shrink the balance sheet a lot, because they'll engender such a collapse like we've never seen before. What they're going to do is going to keep printing money until the bond market collapses.
The market is sending a warning that looks bigger than a normal pullback. Consumer confidence is weak, yet officials still present the economy as stable, which makes the next downturn look more dangerous than many investors expect. Peter Schiff, a well-known economist and gold advocate recognized for his criticism of central banking, and Michael Pento, a macro strategist and portfolio manager known for warning about debt-driven bubbles, argue that today's pressure should be seen through the larger lens of inflation, debt, and a Federal Reserve trapped by its own policies. The main risk is not simply recession, but the response to recession, with federal debt already extreme and deficits likely to surge in a downturn. Policymakers may choose to create more money rather than pursue real discipline. That could support asset prices for a while, but it also raises the risk of a bond market break, a weaker dollar, and higher long-term yields. Gold and silver look positioned to benefit from that setup, especially if investors begin to see rising nominal yields as a sign of inflation pressure rather than real strength. Gold may hold near $4,000 before attempting another move toward $4,400 to $4,500. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I think there's support around 4,000 for gold. And so I don't expect much lower than that. And I do expect the uptrend to resume. It's hard to say exactly when.
Understood. And
we just got to break out below that upward, the top line there. That's resistance, this downward sloping line.
Oh, yeah. That one right there, around 4,400.
Yeah, maybe 45. We break above that, then I think we're just going to continue to make new highs. I mean, silver had a major breakout when it went through 50, really, the upper 40s, which was a double top from 2009 or 2011 and 1980. And of course, we overshot once we really broke through. We just went, straight up and got up to like 126. Now we've pulled back. We're basing. We've broken out, and we're headed to much higher prices. Consumers are even more negative about the economy than they were during the Great Recession that followed the 2008 financial crisis. If everything is so great, why have consumers never been so despondent? That obviously the numbers don't tell the real story. Donald Trump is the most unpopular he's ever been. Why? Because the average person's life is getting worse. So Wall Street is partying, but Main Street is suffering. And that's part of the inflation choice. When you choose inflation, you benefit some people at the expense of others. The people who are suffering the inflation don't have the political clout as the people who benefit from inflation. And one of the major benefactors of inflation is the U.S. government. And that's one of the reasons that they constantly choose inflation. The economy was in recession. I mean, it was obvious that stuff was bad. Things are supposed to be good now, according to the government, according to the Fed. Everything is great. So if consumers are this pessimistic now, what are they going to be like during the recession, the next recession? I think gold and silver are going to break from this correction, and they're going to be headed higher into the end of the year. That'd be my guess.
What about
the dollar
oil?
is now back above 100 on dollar index. I'd imagine it would roll over and head lower. And I think bond yields, the real danger there is a big breakout in bond yields. Bond yields moving substantially higher. And gold investors recognizing that that's bullish for gold, not bearish. Because gold, it's real rates that are important, not nominal rates.
Right.
And I don't think bond yields will rise as much as inflation. They both can rise, but I think inflation will rise more. So that means that yields are falling, even though nominal yields are rising. And that's a very good environment for gold. The Fed can hike rates aggressively, but they're kind of boxed in there because we have so much debt. The Fed could try to step up open market operations, quantitative easing, and buy the bonds. In order to do that, it has to create more inflation, which is throwing gasoline on a fire that's already blazing. So I don't think there's any real way out for the Fed. So again, this is a crisis. It's just a question of how soon does it hit.
The Federal Reserve knows that the next recession is not going to be a recession. It's going to be a depression. That's why they're willing to pump in trillions and trillions of preemptive dollars credit to make sure we don't ever have a drop in asset prices. The over financialization of this economy and the level of asset price, the historic level of asset price valuation, I'm talking about real estate and equities primarily, is so off the charts that they understand that we're not going to have, if we have just a normal run-of-the-mill contraction in the economy, it is going to make home prices drop by 25, 30%, and the stock market drop by 50 to 80%. They understand that. And they understand how devastating that's going to be. How much of this economy, in fact, almost all of GDP growth is, AI investment right now. They understand when that ends, and it will, they can't keep this going forever because the bubble in the bond market is going to force them to stop that. It's going to force a contraction in borrowing upon that AI investment bubble. It's going to happen no matter what the Fed does. But they know once the economy contracts, the government balance sheet is so impaired that the balance sheet of the federal government cannot bail out the system any longer. So in other words, last time we had a financial crisis, the national debt to GDP was like 63%.
Right.
Now it's 123%. We've added $25 trillion to the national debt just since COVID. We have $2 trillion deficits as opposed to the last time we had a recession when the deficit was like $200 billion, $300 billion. Deficits are going to go to $5-6 trillion per annum. And that's starting from 123% debt to GDP. So we can no longer allow on saying, we're just going to add to that debt and deficit by printing trillions of dollars of helicopter money and having the Fed buy it all. Inflation will go bonkers, the dollar's going to crash, and the sovereign treasury market is going to crash. So bond yields are going to rise most likely the next, which is completely the opposite of every other instance that we've had a recession. Bond yields have fallen because we had a low debt to GDP ratio and we didn't have an intractable inflation problem as we do now. So that's the reason why the Fed is panicking already and why no one's going to preemptively hike interest rates a lot or really shrink the balance sheet a lot because they'll engender such a collapse like we've never seen before. What they're going to do is going to keep printing money until the bond market collapses. And until that happens, I'm going to stay long the stock market. But when it does, when the insiders know that's happening, I'm going to jump on them, sell, short the market, go long the dollar, go long the short end of the bond market because the Fed's going to drop rates to zero, and then sit back and relax. And now I'm saying the next few months, we're going to see prices fall pretty quickly, I think. If you look at the CRB index, if you look at oil energy prices, if you look at the five-year forward, inflation, I'm not saying prices are going to crash down to 2%. I'm just saying they're going to go from 4.5 back down to around 3. That's all I'm saying. But that's on a second derivative basis. That's a pretty big drop. People who are listening to Kevin Warsh and saying, "Ooh, we've got an inflation problem and the Fed's going to raise rates a lot." I don't think they're going to raise rates if maybe once, if at all, because I think the data coming out in the second half of this year is going to say, we don't have, if you look at home prices, they're leveling off and real estate's a big component. Energy prices are really on the second derivative basis coming down sharply. Commodity prices, same thing. So it's not a deflationary situation. It's disinflation, which is a mathematical term that says the rate of change of the rate of change, second derivative is going to fall from say 4.5 to 3. That's all I'm saying. And that means a lot to investments. That means those people who've been selling gold and silver, especially gold, might want to look at it again before they panic. That's what I'm saying.
The near-term outlook is more nuanced than a straight inflation panic. Commodity prices, energy, and forward inflation expectations may cool enough to create a disinflationary phase, with inflation easing from around the mid-4% range toward roughly 3%. That would not mean the problem is solved. It would only mean the pace of price increases is slowing for a while. This is where gold and silver can become attractive again. If investors sold metals because they expected an aggressive Fed, they may have to reconsider if rate hikes remain limited and the balance sheet keeps expanding. A temporary drop in inflationary pressures could lift risk assets, but the deeper monetary problem remains. That makes patience more important than panic, because a softer inflation print can change positioning quickly without changing the long-term damage from money creation and debt alone. Now, let's get back to the interview.
And the war didn't start until February 28th, right?
Yep. So
what is that? What is that blast higher all about? That is about the insiders buying energy because they knew that Trump was planning to invade.
Yep.
Or
this entire run here.
That's a fact. Israel and America, the generals, the leaders knew that. I guarantee you they were telling people, and that's how they trade. So the model picks up on that. So what I find interesting is that energy's even when the headlines were saying World War III is on the doorstep, and we're going to destroy the civilization and blah, 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 blah. And this is the last day Iran will be a country. Oil was crashing. As a matter of fact, if you look at five-year forward inflation expectations, they're crashing too. And they peaked at the same time.
Oh, okay.
So the model is reading that and saying somebody knows something and ignore the headlines and just stick with your model. Financial conditions, credit spreads, five-year forward, CRB index, energy price. And that tells, these are all parts of my model. And that's why I didn't get bearish. I was buying this whole time, getting longer of equities. Completely counterintuitive to viscerally what I wanted to do. Now I think what you want to understand is that about this war, and we can put this one to bed. The market's gone beyond this for a very long time. Both sides would like an off-ramp here. Trump even admitted it yesterday. I believe he said, "Listen, if we didn't find a way to open up that strait, oil prices would be like $200 a barrel. The global economy would crash, and that's not going to help anybody, especially not him in the midterms." So he's agreed to make peace. This is not unconditional surrender. This is Trump realizing he made a mistake, in my opinion, and doing the right thing. I give him credit for doing the right thing. He's doing the right thing. He's getting out of this war. The only two ways of ending this war is occupying Iran for multiple years and opening up the strait that way. That's one way to do it. And that would cause oil to, it would be a hue and a cry in this nation, and there'd be all kinds of problems with the election in November, and the economy would crash. Oil prices would soar, at least in the short term. So he didn't want to go that route. He meant the other. This MOU is an agreement to make an agreement in 60 days. And if we don't reach an agreement in 60 days, we'll just extend it to 90 until the midterms are over, or maybe even beyond that. I don't know. But short term, the war is over. Energy prices are going to fall. I don't think they're going to fall back to where they were. Because we still have a big problem in the Strait of Hormuz. This is not over with. But the salient threat of $200 oil, $150 oil a barrel is done. It's over with for now. So that's what the market's trading on. But it's also trading on something else. If I could just dovetail into something very important. Sure. Kevin Warsh, who I had hoped, or maybe maintained some vestiges of hope still, is an Austrian economist, and he knows about money supply. He knows about the balance sheet. He knows that inflation isn't caused by growth or low unemployment rate. Inflation, as he says correctly, is a choice. It's a choice that Mr. Powell made to an exponential degree. I mean, this man missed the Fed 2% inflation target for well over 5 years, and didn't care. He was lowering interest rates into that, which I think is disgusting. He also oversaw the increase of the balance sheet by $5 trillion. So it is a choice. Warsh knows that. Powell maybe knew it, didn't avow it. He was like, oh, wow, temporary, transitional, or transitory, whatever the hell he said. So, but Warsh, I had hopes for Warsh. Warsh knew that inflation's a choice. Warsh knows inflation's a choice. He's avowed that stance. And he knows inflation comes from the Fed's balance sheet. It's all about the balance sheet. It's all about the Fed creating high-powered money, which is handed to banks, and banks use that to expand the broader monetary aggregate. That's how inflation gets going. And of course, you can circumnavigate the banks by just, running up debt and handing people checks and having the Fed monetize that debt. You can do that too. But so this way you don't have to worry about if the bank's going to make a loan. They'll just send you a check to the Treasury, called helicopter money. They did in COVID. And then the Fed monetizes that, which is what they did. So I had hoped that Warsh would come out of the gate saying, we have stopped the increase of the Fed's balance sheet. We're going to scarce reserves instead of adequate reserves or abundant reserves. He said a week ago that he is going to expand the Fed's balance sheet by $10 billion per month. And what I found really disgusting is that he actually, after he took the helm of the Fed, he's already expanded it by $14 billion in a week, which is more than 10 in a month. So I'm really disgusted that he did that. Now, he says the Fed's going to get inflation to 2%. Maybe they will, maybe they won't. I mean, we're lapping tariffs. We're lapping we're taking away a lot of the oil price increase. So maybe we will get back to 3%. I don't know about 2%. But I'm personally very disappointed that the Federal Reserve won't shrink. Forget about stop the growth of the balance sheet. I'm very disappointed the Fed will not shrink it, at least not now.
Central bankers choose inflation. All the politicians choose inflation, because if you don't choose inflation, you're choosing something much worse from their perspective. Because if you choose to fight inflation and get rid of inflation, you're choosing a bear market in stocks, a bear market in bonds, a bear market in real estate, a recession, maybe a default on treasuries, massive cuts in government spending. None of this anybody wants. So in order to avoid all that, the central bankers choose inflation. The government chooses inflation. And I think this Fed is going to make the same choice. I don't care how much noise they want to make. At the end of the day, politically, that's what they're going to do. People maybe perceive like chips or something as like a new store of value, safe haven. I don't know. But that's the only thing that's working. And so I think the risk capital just gets funneled into the names that are still going up.
Yeah.
And it kind of sucks all the air out of the room. Hawkish Fed and higher interest rates. But again, I don't believe that. I mean, if Warsh wanted to raise rates, they had an opportunity to do it yesterday. Why didn't he do it? Instead, he established 5 task forces. I mean, come on. We don't need a task force, let alone 5 of them. You got an army of people already at the Fed, and he doesn't know what he needs to do. He needs to have a task force, figure it out. It's like in the government, when they don't want to solve a problem, but they want to act like they're doing something about it, they set up a committee to study it.
Yeah.
And that's what he did. He set up a task force, a multiple task force to study. I mean, one of the task force is supposed to study the driver of inflation. Like, why do we have inflation? Well, I mean, we don't need a task force for that. The Fed is the driver. The Fed creates inflation by choice. We don't need to waste money trying to figure that out. It's the inflation that's going to be the tailwind for both. Inflation is going to drive yields higher and silver higher and gold higher at the same time. And inflation obviously got worse in the 70s, and you can see the trajectory, escalating during that time period.
The bigger prediction is that policymakers will keep choosing inflation because the alternative is politically and financially painful. A serious fight against inflation would mean lower stock prices, weaker real estate, pressure on bonds, spending cuts, recession risk, and possible stress in the treasury market. That is why any hawkish language from the Fed should be judged against what it actually does with rates, liquidity, and the balance sheet. Gold and silver could move higher together even if bond yields rise, because the key issue is real purchasing power, not just nominal rates. If inflation rises faster than yields, real yields fall, creating a supportive backdrop for metals. Silver's breakout above the old upper 40s resistance area suggests the market may already be preparing for a larger advance after the latest base. Energy may cool if geopolitical risk fades, but the structural problem in the Strait of Hormuz and the broader debt picture have not disappeared. The strongest takeaway is that temporary calm should not be mistaken for repair. The system still depends on more credit, more liquidity, and eventually higher hard asset prices. That leaves metals as insurance against policy promises that may weaken when markets finally demand restraint again. Share your thoughts about this interview in the comments section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.